Hi, I'm Janine Theus, and I'd like to welcome you to this very short presentation on the science of investing. We're going to take about 50 years of research and cram it into about 5 minutes. So put on your seatbelts, because here we go. This is a crazy quilt of asset class returns. What's an asset class? The S&P 5, large U.S. growth, international large, international small, U.S. small. Those are all asset classes. And this quilt shows all these different asset classes and their returns over the last 40 years. So we'll just focus on one particular asset class, which is easy to see. It's the blue, the darker blue. That's the U.S. large company asset class, which is essentially the S&P 5. And if you look, there is no pattern to any of that blue, or the red, or the yellow, which means that returns are random. And so if I don't know which asset class is going to be at the top in any given year, then maybe I just want to own them all, which is the basis of the research. We don't know what's going to happen. We can only look at the past and go, this is what they did. So if I don't know, then I'm not going to try to chase. I'm just going to try to own the whole market. And this quilt allows us to look at what happened in the past. But going forward, we need to have a strategy that incorporates all these returns. So this is based on 50 years of research, and there are 5 factors that determine this return. Equities, stocks, are riskier but have a higher return than bonds over time. Value stocks create more return than growth stocks. A growth stock is basically what you include in the S&P 5, or what you're thinking of as the S&P 5. Small cap stocks outperform large cap stocks over time. A little more risky, but more return. Profitability, which is a new factor, which says that companies that are profitable tend to stay profitable. I can build into algorithms that I filter for in building funds. So we use profitability as an indicator or a factor of return. And then momentum is companies that are doing well tend to continue to do well, found on a different piece of the profit and loss statements of companies and the fundamentals. So if computer software, the algorithms that you build these funds on are based on these 5 factors that allow me to capture the returns. There is no crystal ball. There is no, there's no hyperbole here, which is what the financial media machine wants you to think, that they can predict all of this and build that into a portfolio. I don't want to deal with these guys. I just want to capture the returns. So let's use the science and the academics research. And this is what we're talking about in terms of performance over time. What we're looking at is, on the left, is the average equity fund investor is 3.6. That's based on years of research by Dalbar, which is an independent research company that says the average equity investor's return is 3.6. There are a lot of reasons for that, but when you look at the data, that's what happens because people are chasing constantly. Compare that to the Bank of America Treasury note at 4.9. The S&P 5's long-term rate of return is 11. And then if I have a globally diversified portfolio properly allocated, I should be able to expect roughly 12%, not every year, but over the long term. So this is typical for the investment experience for most investors is, since they're chasing return, I'm going to get rid of this fund that's not performing well, and then I'm going to go buy this fund that is performing well, which means I am buying high and I'm selling low. And that's a recipe for disaster for your portfolio, especially as you get closer to retirement or in retirement. What we want our clients to do is relax and just capture the market. So I'm going to buy on all the dips because I'm rebalancing the portfolio as the market moves. So that lets me have a fully integrated portfolio, globally diversified, all the asset classes properly allocated to my risk-return ratio, and then I have an expected rate of return for the risk I'm taking. Science proves that works over time. Why does it matter? 92% roughly of a portfolio's performance is based on its allocation. Everything else is noise. Stock picking, fund picking, track record investing, market timing, all the other influences, news. That's all noise. And you should not be reacting to all this noise. You should have strategy going forward. Why does this really matter? Your income in retirement will most likely depend on your savings and Social Security, and if you have a pension. You've got some options. But if it's solely based on your savings, you want to get that right. So how will you replace your current income? How are you going to do that with the amount of money that you've saved and how it's allocated? Will your current allocation work? And when would you like to know if it's not going to work? Sooner rather than later? So here are your near or post-retirement risks. Longevity, how long are you going to live? How long would you like the money to last? Those are usually the two most important questions that people ask. Inflation, are you planning for inflation? Interest rates, when interest rates change, what does that do to bonds? And how does that affect your portfolio? The stock market returns, again, what are they? We know what they are long term, and how am I going to use them in my portfolios? Public policy, taxes, things like that, you have no control over, I have no control over, but they do affect what happens in our money decisions around the money. Unexpected health crises or catastrophes or care needs, death of a spouse, divorce, which I always tell folks is the quickest way to poverty. Bad advice and poor advice can definitely affect your portfolios. So, and then disability. What happens if something happens and you have a long-term care need? These things are all factored into long-term planning for long-term investment performance and procedures. So, just some questions to think about. What's the money for? What is the time horizon that we're talking about? If you're healthy at 60, you're likely to live to 90, statistically speaking. We have to make sure the money's going to last, so the portfolio has to work. How long will what do you need to decide now? What are the money decisions around the money? How are you working through those? And how are you coordinating all these decisions? Do you have a quarterback? Or are you your own sounding board? So how are you playing the chess game? Successfully replacing your income is going to require some serious planning, because are we replacing your current income or a particular income? And that's going to take an examination of everything that you're doing, including the risks that you're currently taking, the taxes you're going to pay or are currently paying. How about costs in portfolios? Social Security timing, what is that going to cost you and when are you going to take it? And then any pensions that you may have. So all of this is concluded in financial planning analysis, and all of the money decisions around the money are just as important as the money itself. So sign up below if you'd like a preliminary conversation with us, and we will also get out to you a free report. So thank you for your interest in this course, and we talk to you soon.